Hey guys, welcome back to the After Hours. I'm the A-Tail Beast, and today we're going to talk about the failure of the banking system. Now, today we're going to give a rough example of what happened inside of the banking system, where you may get some of your money, and just highlight overall risks to the broader market. So, I was asked, what are your thoughts on people withdrawing their money from the banks? Some people who invest money are worried about what might happen in the stock market crash. They think that if that happens, the bank might not have enough money to keep going, which could be bad for everybody. In the past, banks made some risky investments that caused them to lose a lot of money. So now it's important for them to be careful and have enough money saved up in case bad things happen. Some investors think that the government might need to help the banks if they get really lost, while some investors see the stock market crisis as a reason for the Fed to pivot. Why? Because there is a concern about the liquidity of the banking system during a stock market crash. Despite improvements in liquidity and resilience, there are still vulnerabilities that could be exposed in the event of a major crisis. Therefore, it is important for banks to manage their risk carefully and maintain sufficient liquidity to avoid collapse. The buying of too many bonds during the peak of quantitative easing and the subsequent quantitative tightening triggered by the Federal Reserve, this leads to losses for many banks, such as Blackstone and Signature Bank. Blackstone, the world's largest asset manager, which lost over $500 million in property recently, could have had a significant impact on the financial system that could impact the broader economy. There are concerns about the liquidity of the banking system during a stock market crash. The leveraged investment in derivatives like options and various swaps put a hole in the pocket of the economy. The defaults of real estate and multiple loans made a crater inside of their saving account. Investors are rotating to risk-free investments like bonds, leading to a sell-off in the stock market. Some investors see the stock market crisis as a bullish indicator for the Fed to pivot. If we look at the past week, the overall performance of the market has been going down, but today we finally came up green. And this all comes from the twisted interpretation of the sentiment of the market. It's uncertain times, and to answer the people's question of should you take your money out right now, I think people may see this as another reason to start QT. So not yet. First thing you should know is people are split. They're split across two divides. On one side, people are worried in the event of a stock market crash. Can the current banking system handle the crash? And if it can't, where does that leave them? They have the right to be concerned because history has proven them correct. If we go all the way back to 100 years ago, we'll see a very similar situation to right now. And that is the Great Depression, is what I'm talking about. Now, during that time, we saw the banking system fail, and they failed because they didn't have enough reserves on hand. That's extra cash. Now, that extra cash is there so it can weather certain crises and major events in the stock market. The reason you need to have that extra cash is because if everyone comes to you at the same time and takes out their money, the bank can't keep its bank open. And because of that, we have improved liquidity and resilience when it comes to people that want to take out their money all at once. Because when they do that, it's called a bank run. That's when people come in mass to do withdrawals. And since then, we've changed our banking system to the fractional reserve banking system. This pretty much says that the Federal Reserve, the central bank, they have the right to put a percentage on how much you have to hold inside of that bank, and then the rest of it, it can be lent to other investors. Now, that's a great system if everyone doesn't run into the bank and take their money out. That event only happens when everyone in the market knows that the entire economy is going down, or the reputation of that bank is crushed, and then they don't trust that bank anymore. This is exactly what happened during the Great Depression. And since then, to regain the trust of the banking system, we established the FDIC. And this pretty much ensured that people can get up to $250,000 of their money back, and they trust the banking system again. Things may have improved, and in the past, banks have made mistakes by taking extremely risky investments, especially with money that wasn't theirs. So where's the difference here? Well, the difference is now we've had several years of QE. Now QE, this is when they turn on the printer and they put a lot of money into the money supply. When they do that, if managed improperly and things go out of a fixed amount of range, inflation gets entrenched into the economy. And when that happens, it increases the income inequality as well as inflation of asset prices. Now, there's always a check and balancing system, which is supposed to be the Federal Reserve, but that's just one of the systems. At the end of the day, what they do is they take bonds, they buy them during QE, and then they sell them during QT. This overall controls the inflation by suppressing it, or they'll buy from those same banks and financial institutions, giving them more money so they can weather the storm. Now, the problem happens when people lose faith in both the Federal Reserve as well as the overall banking system, because it's going to spur them to go withdraw their money. They call that a bank run. Now, in the last bull market, which lasted almost 10 years, there were way too many bonds that were bought. And what this did was bond value went up, which made the yields for bonds go down. And now, when we talk about bonds, they're supposed to be the safest investment. Now you have a lot of investors rotating from high risk investments to almost risk-free investments, because the rate hike increases from the Federal Reserve have been constantly increasing, as well as inflation. This leads to stagflation. When you have constant rate hikes increasing, trying to suppress the inflation in the economy, with the Federal Reserve expected to increase the target at which they increase the rate hikes, on top of inflation increasing because it's too entrenched, things get out of control. Remember, if you don't moderate that range properly, it's going to take over. And the only way to get ahead of that is to get ahead of it with rate hikes. Now, because of that, the entire impression and expectation in the stock market says that the Federal Reserve is going to have to raise the rate hikes a lot faster than everyone expected, especially the banks, because they made prediction models that were completely inaccurate. Now they don't have enough reserves to cover everyone's withdrawals. That's leading to a potential plunge in the stock market, which can overall lead to a crash in the stock market. Now that's just one side of people's concerns. The whole process of all the banks over the past 10 years of QE buying way too many bonds and then triggering the Federal Reserve to do QT, which they sell those bonds, making the bond value go down and then the yields go up, made people think that they can switch over to risk-free investments and get higher returns with massive amounts of money, instead of just waiting for the interest inside of their bank to accumulate. Another example is they could wait for money inside of the bank to accumulate because of the high interest rates. And overall, the direction of the rates are going up. And so people are switching over to risk-free investments. So this led to losses at some banks, such as Blackstone and Signature Bank. So Blackstone is the world's largest asset manager, and they just recently lost over $500 million worth of property. And this could have a significant impact on the financial system, especially their reputation. Because if the world's largest bank is having problems, what do you think is going to happen to all the local banks? More on that. Recent developments in the financial sector include bank failures in Signature Bank, as well as Silicon Valley Bank. Now, if you know anything about Silicon Valley, this is the bank for all the startups and venture capitalists, especially in the technology sector. You know, the main driver in the economy. So this includes bank failures in the seizure of Signature Bank, one of the third largest banks in the US economy. And this failure was due to a significant amount of investment inside of crypto, another high-risk asset. The current theme is high-risk bets have been made by several banks, such as Silvergate, which led to a domino effect of losses and effects, including the closing of Silver Valley Bank. Regulators had to step in because there have been massive fears. It spread through all the US regional banks. This is where all the high rollers, the ballers are. So all the banks have been doing high-risk bets, especially during QE, and this doesn't surprise anybody, which gives another reason for people to withdraw their money. Another recent development in the financial sector is the increase inside of the approval rate for subprime loans, especially during the increasing credit risk. The banks that have significant investments inside of this market may be the next round to go when it comes to the bank failures. And this is specifically aimed at all the large banks that are supposed to be diversified, according to the regulators, which includes JP Morgan Chase, Citigroup Bank, and Wells Fargo, who are all under scrutiny by the regulators and the investors. They really want them to manage their risk and have enough significant liquidity. Well, we know a few of them are doing their job because they're helping save some of the regional banks. But their history is a little dicey itself. We don't know if this money's clean, but as long as they stay up, we're good, because that's my bank. Now, the large banks are under scrutiny because they have had high-risk investments in real estate, in high-yield bonds, leveraged loans, and derivatives. And they did this at the perfect time, during QE. Now that everything might change because it triggered QT, quantitative tightening, from the Federal Reserve, all those high-risk bets, especially the ones that are directly related to the movements in the stock market, they're all gonna flip on their head. Now, just so you understand, I can't find my glasses. But QE is a monetary policy used by the central bank to stimulate the economy by buying government bonds or financial assets from banks and financial institutions. One of the effects of QE is to increase the money supply, which can lead to inflation if not managed properly. It wasn't managed properly. During the peak of QE, after the crisis of 2008, many central banks adopted this policy to increase the monetary policy and stabilize the financial system. I don't think it worked. So a lot of critics argue that all this buying during the free money era has led to increase in inflation and income inequality and overall lack of trust inside of the banking system. Now, in good faith, they installed the FDIC system, but we don't really trust that if the main people are still the same. Especially when all the benefits that happen from QE go to the people that hold stocks and bonds, not the average person. Sorry, Mom. Sorry, Pop. Not today. Get in your corner. So the leverage investments in derivatives like options or swaps, any of them, any type of swap, credit, currency, I forgot the other one. Yeah, but any of those, they're related to the movements inside of the stock market. So those high returns just became high losses. There goes another blow to the reserves. The amount of defaults are adding up. This is coming from all types of loans, real estate, auto loans. And they're creating a hole in the pocket of everybody. Now, to top things off, President Biden has proposed that we increase the taxes, especially for those inside of the stock market. You could be paying up to 60% of the capital gains. Well, I'm not a fan. But this highlights a lot of the risk inside of the banking system where you may be involved and could be held accountable. Overall, everything's up in the air. Nothing's certain right now. So make sure to do your own research. We'll see how this turns out. Because remember, that's just one side. On the other side, people believe that this may be a chance for the Federal Reserve to restart QE. If they restart QE, we may experience another 5, maybe 10 years of them putting money into the system. If they do that, we're going back to the bull market, everybody. During that time, the stock market will go back up to 500, maybe even more. And stocks are going to come back alive. Now, when things come back down, they're gonna come back down hard. But if the Fed does come in with the save, with the Fed pivot, next time we're gonna be ready with the correct investments. I'll be in the penny stock market because they're gonna pop up everywhere. All right, we covered a lot. We talked about the federal system. We highlighted on where we kind of stand in there. We also highlighted how no one knows what's gonna happen. Overall, you're screwed. But it's okay. As long as we can survive this period, maybe we can survive another round of QT. I know if they start another round of QE, there's gonna be more penny stocks. Hopefully we don't have to pay 60%. But other than that, if you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.